Good morning. Welcome to Stock Market Today. It's Thursday, December 13th, 2018, and I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can follow me on Twitter. I'm at Dan Russo _CMT. And if you're over at StockTwits, I'm there as well under the same handle. Stock Market Today brought to you today and every day by Chaikin Analytics. And you should head over to chaikinanalytics.com/today to sign up for your free email. Follow along with this show. Get daily stock ideas. So U.S. equities were higher in Wednesday's trading, though closed near the lows of the day as the S&P 500 gave back early gains. Consumer discretionary, materials, and healthcare were the best performers. Defensive sectors finished lower. Treasuries were weaker across the curve. Gold finished up 20 basis points. WTI crude settled down 1%. Breath on the New York Stock Exchange, positive 1.9 to 1. Breath on the NASDAQ, positive 2.2 to 1. So as I said, discretionary materials, healthcare, and throw in comm services as your four leading groups. Your underperformers were those defensives, REITs, utilities, staples, and throw energy in as well, though energy was positive, just less positive than the overall market. As we get as we get to the desk this morning, S&P futures are up about 10 basis points after that higher close yesterday, though the late day sell-off to close near the lows. Asian markets were higher overnight, with China up over 1%. European markets are stronger as well. Treasuries are slightly stronger. The dollar is mixed versus the yen and euro. Gold down 30 basis points. WTI crude off another 0.5%. So here's the S&P 500. Here's that well-defined trading range that we've been talking about. Here's that sell-off. That's actually an ugly candle. Now, futures are up this morning, but that's we don't like to see a candle like that. You know, open, shoot higher, and then close lower near the lows on the day below the open. That's a sign of sellers stepping in to sell into strength. It's been a theme for this market, whether it's on a one-day basis as it has been lately or after these sharp rallies. The sellers have been there to sell into the rallies. And as we said again today, market gave up early gains. Support 2630, then below at 2570 to 2600. Resistance now at the declining 200-day moving average at 2759. And this interim high here at 2815 is the key level for the bulls. That RSI, as we would expect, remains in bearish ranges, and Chaikin money flow does remain bullish, although the intensity of the reading has diminished of late. We'll keep an eye out to see if we dip into negative territory, but so far money flow has been holding up. In addition, we still are working on that positive momentum divergence here as the RSI has made a series of higher lows, but ultimately price is the only thing that matters. We need to see a breakout above 2815. So your market in a minute. If you have the email at home, this is what I'm talking about in my note to Chaikin Analytics clients today. Stocks advanced but closed near the lows of the day. We hit on that. Crude oil moves lower again. Breath metrics in the U.S. continue to improve, but global markets remain under pressure, and futures do point to a slightly higher open today. Power bars for the major indices. Let's take a look at them here. The Dow, 2 bulls to 5 bears. S&P 500, 47 bullish stocks or very bullish stocks, 110 bearish or very bearish stocks. Some NASDAQ and small cap outperformance yesterday helps the ratios, but they are still skewed to the bearish side. 8 bulls to 22 bears for the NASDAQ, 176 bulls to 473 bears for the small cap index. Bonds down, yields ticked higher. Comm services was a standout on the upside yesterday, up over 1%. Kind of a middling group here. 2 bullish stocks, 3 bearish stocks. According to the Chaikin Power Bars, small cap stocks and large cap stocks remain bearish. Major indexes are all bearish as well. Let's look at our stock of the day now. Again, as I've said in the past, this is auto-generated based on our algorithm and looks at very bullish stocks using the Chaikin Power Gauge rating. And today's stock is Renaissancere. Closed at 136.16, down 48 basis points yesterday. Real estate stocks have really been a strong part of the otherwise weak financial sector. So let's take a look at RNR here. Very bullish rating due to very strong price volume activity, very positive expert activity, and attractive financial metrics. Weak earnings performance, however. And for the past year, the stock has really been in this well-defined range. Call it 116, 118 to the downside, 140, 142 to the upside. We are closer to the higher end of that range right now. Very bullish stock, strong trend, strong industry group. So we are fishing in the right pond. Ribbon at the bottom of the screen, we can see that we've been predominantly bullish since the summer, but it's just now, here November, December timeframe, that the market and model are getting into agreement, the dynamic duo getting into gear as the stock has been outperforming the S&P 500. Remember, I said insurance has been a positive group within the financials, one of the leading groups within the market overall. Money flow bullish above the rising long-term trend line. My only concern is that we are rounding out of a pretty big overbought condition, and we are close to the top end of this range. I like buying this stock on a pullback closer to the 130, 132 level, hold above the rising long-term trend line, generate an oversold condition or get close to an oversold condition while money flow stays positive. I think that's a better setup, especially in this market environment where rallies across the market are being sold. I don't love buying a stock close to the top end of the range, close to a resistance level. I think you're better served waiting for a pullback to the middle or lower end of the range, generating an oversold condition to set up a better tactical entry point. I'm adding RNR to my bullish watch list today. I don't love it in the here and now from a tactical setup standpoint. Our sector tracker looks at the movement over the last 5 days for the major sectors in the S&P 500, and we can see is the theme remains defense as far as outperformance goes. Remember that new communications group, while it's added some of the big tech names, it still holds a lot of those old school communication stocks that are viewed as defensive. That group is up 1.1% over the past 5 days. Utilities positive over the last 5 days. Staples and real estate outperforming, though negative over the last 5 days. Bottom of the list of those financials really just coming under pressure. That's the banks, the regionals, and the majors all coming under pressure as the yield curve continues to compress. Energy down with oil. Materials and industrials are victims of the trade war. We'll see if that improves. We've gotten some headlines that negotiations with China are moving in the right direction. Tech, discretionary, healthcare are middle of the road. Our industry in focus today, software and services. Over the past 6 months, this group has underperformed the S&P 500 by 2.4%. And the power bar ratio, which measures future potential, is weak with more bearish than bullish stocks. And it's currently ranked number 5 of 21 subsectors, moved up 1 slot over the past week. That's interesting to me, that you can have a bearish ratio and still be ranked in the top quartile of industry groups. That just kind of shows you that there are a lot of more bearish names within our model than there are bullish names. Some of the indicative stocks within this industry, Square, New Relic, and Switch, all have very bearish Jake and Power Gauge ratings. And for those of you who receive my bearish insights notes every Wednesday, you'll recognize New Relic as our bearish pick of the week this week. New Relic, very bearish stock, weak trend. It is a strong industry group as far as software is concerned, computer software, but not a compelling name here. Very bearish rating since the September timeframe. Market and model in agreement since late September, early October. Dynamic duo in gear to the downside. Market and model in agreement. Very bearish stock, underperforming the market. These are the types of names we know we don't want to own, and we want to consider them for bearish opportunities when the tactical setup is there. And obviously, I made it my bearish stock of the week, and I would say that the tactical setup is still there. Look at the intensity of bearish money flow. Look at the persistency of bearish money flow really since August. Below the declining long-term trend line. Rally here back up to the $85, $90 level sets up a compelling entry point for a bearish trade as the stock has become overbought. Look at your options. Put options or bearish vertical put spreads to take advantage of the tactical setup in a very bearish stock that's underperforming the market. New Relic was my bear of the week this week. I still like the setup for a bearish trade. Looking now at what's trending. Yesterday's S&P 500 gainers and losers. URI up 6.3% as they hosted an investor day. Twitter up over 5%, kind of the stealth name in the internet group that's been outperforming of late. MGM up 4.8%, Win up 3.6%. That's out of headlines. that negotiations with China seem to be improving. Remember, a lot of the casino companies are highly levered to China. The global casino companies, names like MGM, names like Wynn, going to trade on China-related news, in particular to their company-specific news. IPG, just a discretionary name that did well yesterday. Again, consumer discretionary was the leading sector of the market yesterday. On the downside, Under Armour, UAA, down 10.4% as they provided guidance that disappointed the street in front of their analyst day yesterday. Stock down 10%. Mosaic, MOS, caught a sell-side downgrade to send that stock down 6.3%. Macerich, this was a former bearish stock of the week for me. We covered up our position at a nice profit for our clients. Still has a very bearish rating, down 4.4%. Made a 52-week low. And this is why stock selection is so important, because real estate has been strong, but you can't just go out and blindly buy real estate stocks. You have to do the work. You have to look at our power gauge ratings and our other metrics. I was able to go out and make a call that Macerich was a bearish name, even though investors were going to the safety of real estate, and that call paid out, and it still continues to play out. That's why the model is so dynamic. PSA, another real estate name, bearish rating, caught a downgrade today. Don't know what the news was yesterday. Didn't really see any news to send that stock down over 3% yesterday, and no real news to send UDR down nearly 3%. So what am I talking about today? I know crude oil trades lower, but it is holding support. Does remain under pressure, but we do have some solid support in the $50 level. Seeing some positive divergences here as we come out of a deeply oversold condition. Chaikin money flow still bearish, but improving. Below the 50, below the 200-day moving averages, both of which are declining. I think crude oil has some really solid resistance in the 58.60 zone, and then again around $64. You can use rallies in the price of crude oil to look for opportunities to sell bearish and very bearish energy stocks when they become overbought. That's our process. Avoid or look for bearish positions in the weakest names, in the weakest parts of the market, when they become overbought. And there's nobody right now who can argue with the fact that energy and the energy-related names are a weak part of the market. But on the positive side, we are still seeing positive breadth divergences in the U.S. Here's the percentage of stocks above their 200-day moving averages. And I don't want to get overly excited about this just yet, but it is a sign that the lows that we made in November and December for the S&P here and then on Monday were less intense than that initial low in October. That's a bullish breadth divergence. But really for this metric, I want to see it back here above 60 as a sign that a healthy majority of names are in long-term uptrends. That's just not the case right now. What I do think, though, is that these positive breadth divergences here as well as here, here's the advanced decline line for the S&P 500, and you can see that as the market was making lower lows on a closing basis and really, but still holding above support, we've had higher lows for the advanced decline line. That's another positive breadth divergence. What does that tell me? That tells me that support is likely to continue to hold in the near term, and you want to utilize pullbacks in the S&P 500 to that support level to buy bullish and very bullish stocks in leading parts of the market when they become oversold. However, I do want to see 28.15 broken to the upside to give me conviction that the bulls are regaining control. Now, global markets remain under pressure. Here's the ACWI, the iShares, MSCI, ACE, ACWI, ex-US ETF. Solid downtrend despite a recent rally, below the 50-day moving average, below the 200-day moving average, both of which are declining. This low down here was met with a positive divergence, but the trend is still negative. But what's interesting to me is that after a long period of underperformance, ACWX is stabilizing relative to the S&P 500. A lot of people have been making the call that on a valuation basis, global markets look better than the U.S. markets, and maybe we're starting to see that theme play out a little bit. It's a relative basing. We haven't seen a breakout to the upside yet, but it's something we are keeping an eye on because obviously if money begins to flow to global markets and leaves U.S. markets, that will make it harder for the U.S. markets to turn higher. So that's it for today. Get daily stock ideas for free. Sign up for the email. chaikinanalytics.com/today and help us spread the word. Share our link on social media. I'll be back here tomorrow at 9:15. See you here.